Okay, we're live, everybody. How are you? Welcome to our transmission. We are going to get started in about 5 minutes as more and more people join. So we'll be with you in just a second. Welcome. Yes, so it looks like it's a screen share. So we're going to talk a little bit about residential real estate costs today. Thank you all for joining. Basically, today what we want to try and do is talk to you a little bit about one of the most commonly asked questions of title companies and real estate, which is who is responsible for paying what? Okay, who is responsible for paying what? Now, the responsibility of paying for closing costs in a real estate transaction really comes from the contract, okay? The contract is what states what costs are going to be paid by buyers and sellers. So today we're going to go through a little bit of those contractual obligations, and we're going to talk a little bit about what a buyer and a seller can expect in terms of these real estate closing costs. We're going to break down the different areas of the costs, and we're going to break down how those costs can be managed and what can be expected of the real estate transaction. Okay, so we're going to try this one more time. Okay, so let us begin. We're going to talk today specifically about the purchase and sale contract, the as-is purchase and sale contract. And in the Florida as-is purchase and sale contract, you guys are going to be familiar with paragraph 9, which talks about the closing costs in real estate. Okay, so when you look at paragraph 9, you're going to see 3 sections related to these closing costs. Right? You're going to see section A, which is the section that has to do with the cost to be paid by the seller. You're going to see section B, which are the costs that are related to the buyer. And you're going to see section C, which are the title-related expenses, okay? So let's start from the beginning and what the contract says the seller should pay for, okay? So the as-is contract says that the seller is going to pay for the transfer taxes on the deed, okay? Transfer taxes on the deed are taxes that are mandated by the Florida Department of Revenue and are paid on the value of the property, okay? We're going to go into that detail in a little bit. The seller also should pay for any expenses related to FERPTA. So if you have any foreign sellers, they would be paying the expenses related to FERPTA. Third, you have any HOA or condominium estoppel fees, any recording fees that are needed to cure any kind of title defect. So anything that needs to go into the public record that there's a title defect belonging to the seller has to pay for it. And of course, if the seller hires an attorney, the seller will pay the attorney fees, right? Now, when we I am actually going to give me a second because I'm getting some messages here about trying to share the screen. Let's see if this works. Let's see. Sorry, guys. I was trying to share the screen with you. My apologies. Okay, so now we talked about a little bit of the seller expenses. Now we're going to go to the buyer expenses, right? What are the buyers expected to pay in a real estate transaction. So the buyers are expected to pay any taxes or recording fees related to the mortgage, right? It makes sense. If the buyer is going to get a mortgage, they're going to have to pay the expenses related to the mortgage. And in Florida, the mortgages pay a doc stamp fee and an intangible tax fee. And I'm going to break that down as well in a bit. If it is a platted property, not a condo, the buyer would need to pay for their survey. If there is an association, the buyer pays for the association application. If there are any other loan-related expenses that the lender charges, the buyer would pay the lender charges, the appraisal fees, the buyer's inspection, the buyer attorney fees, and any property-related insurance, any property-related insurance that is required on the any property-related insurance that's required for the transaction. All of these expenses for the seller and the buyer are in the contract. So when someone asks you, how do I know who pays for what? The short answer is, let's find the section in the contract for the expenses. Now, right now we're talking about the Florida residential FAR bar as is contract. But any contract in residential real estate should have a section of costs. For example, the Association of Realtors has a vacant land contract. They have a commercial template contract, and even a contract that an attorney would draft themselves will have a section to understand how the expenses are shared. Okay. So now let's go to the third section of the contract. This is a section that generates an enormous amount of confusion, which is the title-related expenses, right? The title-related expenses. The title-related expenses section in the Florida as-is contract essentially proposes three options. Option one is that the seller pays for the title-related expenses. Option two is that the buyer pays for the title-related expenses. And option three is an option called the Miami-Dade Broward Regional Provision. And in the Miami-Dade Broward Regional Provision option three, the title-related expenses are shared. So one of the most commonly asked questions that I get is, who chooses the closing agent? Who chooses the title company that's going to do the closing? According to this section, section 3 of the costs, the party that chooses the closing agent is the party who pays for the owner's title insurance policy. The party who pays for the owner's title insurance policy has the right to choose the title company. Now, if you choose the first option, the seller will choose and pay for it. If you choose the second option, the buyer will pay and choose the closing agent. If you choose the third option, which is a Miami-Dade Broward Regional Provision, the buyer will pay for the owner's title policy and the buyer will choose the title company. But the seller will pay for the lien search and title search. So really, in Miami-Dade Broward Regional Provision, which represents a huge amount of the transactions in the state, the expenses for title are shared, where the buyer will pay for the owner's policy and choose a title company, and the seller will pay for the lien search and the title search. Okay. Now, what we're going to do is, after the webinar, we're going to send you guys a recording with the slides, and we will walk you through the differences between each one of these options. Where essentially, in summary, in option one, the seller pays the owner's title policy and chooses a closing agent, the lien search and the title search. In option two, the buyer pays the owner's title policy, the lien search and the title search. And in option three, the buyer pays the owner's title policy and the seller pays the lien search and the title search. All right. So this generates a lot of confusion, and it's actually in the contract. Now, these are always negotiable. There are counties in the state of Florida where it is customary for the seller to pay for the owner's title policy and choose the closing agent. For example, in the metropolitan Orlando area, in the metropolitan Tampa area, metropolitan Naples, Fort Myers, it's usual that the seller will pay. In many other counties, it's usual that a buyer will pay. In Miami-Dade and Broward, it's usual that the expenses are shared, but the buyer, because they're paying the owner's title policy, will choose a closing agent. All right? Okay. So now let's talk a little bit about, let's go into detail about how to think about these closing costs. Because another of the most frequently asked questions is, how much should a buyer and a seller expect to pay? How much should they pay if it's a cash deal? How much should they expect to pay if it's a loan deal? Okay. So I want to propose to you guys 5 sections, 5 types of closing costs, right? The first are title related expenses. We briefly touched upon those. The second are expenses that have to do with government recording fees, right? So a lot of the government related expenses and taxes. The third is other expenses related to closing, right? The fourth is expenses specifically related to the loan, right? The fifth is what the lender requires for escrows and prepaids. And by the way, I appreciate all your questions in the chat. What I'm going to do is I'm going to like take them all in and then we're going to do them in the end, okay? But please, if you have questions in the chat, please add them here, okay? So 5 sections of closing costs, right? Now, the first section of closing costs we briefly touched upon, the title-related expenses, right? The title-related expenses essentially has, the title-related expenses essentially has 4 kinds of expenses. It has a title insurance expense, it has a title search expense, a lien search expense, and a settlement fee. The settlement fee is essentially the cost that the closing agent charges to do the closing, to perform the service, okay? Now, title insurance, it's important that you know that the rates for the policies are set by the state of Florida. So theoretically, you should find the same price for title insurance, basically no matter the closing agent that you use, because there are promulgated rates by the state. Now, there are some differences, right? It's a complex formula. So you will find that certain companies may charge more for it. It's technically not illegal. It's just not the promulgated rate. There are some companies that may say if there's a reason that they can give you a discount, there are certain allowed discounts by law, okay? The lien searches cost depending on the municipality. Or the city. You have a city like Hialeah that has lien searches that cost over $500. You have other cities where a lien search can cost $100. Okay, so depending on the city and the municipality, it will depend on the cost. Title searches usually have a fixed price. Residential title searches usually cost about $200. Commercial title searches usually cost about $275. And then settlement fees vary pretty widely amongst closing agents, right? What's important to note is that some settlement fees include all the administrative services. Other settlement fees are lower, but then they add on a bunch of administrative expenses. So when you're trying to compare costs, it's important to compare apples to apples. And what I invite our clients to do is when they say, can I have an estimate of closing costs? My client is evaluating a couple of companies. Absolutely, we're happy to do that. And what we invite the client to do is, if you show us the quotes that you have, at least I will point you to apples, because sometimes it's not that easy to compare exactly what the expenses are, because there are slightly different charges for different things. So you just have to make sure that when you're comparing quotes, You're comparing apples to apples. Now, so that was the title related expenses, right? Second, we're going to do the government recording fees and taxes. Uh, when we talk about government recording fees and taxes, you have to know that a property transfers and legal documents related to property transfers that might include like some affidavits need to be recorded in the public record, right? In the public record. So the recording fees are usually fixed uh, and they're charged by page. So usually the first page is $10. Each additional page is $8.50. That's why you'll see that a deed usually costs about $27 to register because it's 3 pages. Now, when you have to pay for a mortgage to be recorded, some bank mortgages are 16 pages long, some bank mortgages are 30 pages long. Whatever the amount of pages the bank sends you, you have to record them. So you'll usually be paying for a mortgage about $250 to $300, right? Now, when you get a mortgage, and in the presentation that we're going to send you afterward, you're going to have a link to the Florida Department of Revenue, which breaks down with even more detail than I do these things, right? So when you do get a mortgage, you have to pay doc stamps on the mortgage. And the doc stamps on the mortgage are 35 cents for every 100 in value. So a $300,000 mortgage will be $1,050 in those doc stamps. There's another tax called the intangible tax, right? Where the intangible tax is 20 cents for every 100 in value of the mortgage amount, right? So the doc stamp taxes and the intangible stamp taxes are paid on all mortgages, okay? So when you see the quote, you will basically be able to see this in 2 places. If you're getting a loan, your lender will put this in the loan estimate because it's a statewide tax. And when the title company gives you a quote, they will usually break down the taxes because you need to know essentially how much cash you're going to need to close the deal, correct? So that's why these government recording fees and taxes, these all depend on the values of the mortgage and they depend on the amount of pages. So sometimes there's a variation. Sometimes, on the contract you put that you're getting a mortgage for $380,000 and maybe you end up getting a mortgage for $360,000. So you could see slight variations there, okay? Now the third section of costs we're just going to call other closing related expenses. Here you have things such as broker fees, right? Almost to my knowledge, every broker in Florida has broker fees, in part because brokers have additional expenses for compliance with the state. Some brokers charge $4.95, some brokers charge $6.95 or even more. So more or less your client, when they sign documentation to work with you, they should know that there are these broker fees, and that will be detailed in the other closing cost expenses. You have costs like surveys, which is basically the study of the boundaries of the property. You have estoppels. Estoppel is a term that when I started this, I needed to look up in the dictionary. I really didn't know what it meant. Estoppels are essentially a formal statement, a formal letter from the association that outlines the standing of the current homeowner, in this case, the seller, with the association at the time of sale. So what are the dues? Do they owe any money? Are there any special assessments? Are there violations on the association? So the estoppel has a fee, right? That is mandated by statute, right? Which is $250 regular or $350 rush. There is new legislation that is trying to eliminate the cost of estoppels. We'll see where that ends up. And then you have other fees, right? Courier fees. You have wire fees. You have the fees that you need to pay for to directly close a transaction, okay? Now, these 3 fees will be these 3 blocks of fees are going to be present on a cash transaction and a loan transaction. Do you agree? Right? So these 3 fees more or less are going to be similar. Obviously, the transfer tax, the doc stamp taxes and intangible taxes on the mortgage only apply if you have a mortgage. But these 3 general categories you'll find in both cash and mortgage transactions. So now let's go to the 4th kinds of fees, which are only fees related to the loan, only if you get a loan, right? So many times we have customers who are evaluating whether they should pay cash or whether they should pay with a loan. And what they want to know is, how do you compare the two expenses, right? How do you compare the two expenses? So essentially, um, the way that you compare these two expenses is by doing a projection in cash and then a different projection if you have a loan. So let's talk about the loan related expenses. We have a lot of lenders on today's webinar, which I appreciate you joining, because we work together we have to close a deal. We have to work with realtors, work with lenders. All of us have to work together to close this deal. So I appreciate the lenders who joined today. Loan related expenses, you have processing fees, right? Sometimes you have underwriting fees. You will have an appraisal fee unless there's an appraisal waiver, right? It's very common question: who orders the appraisal and how does it get paid? This is especially a question for a lot of foreign clients, where in a different country, maybe they order the appraisal themselves. They order it directly. Here, the lender orders the appraisal. When does the lender order the appraisal? Well, when the disclosures are signed and the client pays for the appraisal. Usually they pay by credit card, right? So when you're considering the appraisal fee, which can go anywhere from $550 to $1,000, depending on the property, you want to work with your lender to get that done as early in the transaction as possible, unless there's a reason why you don't want to get it done. But a lot of clients, when it comes to these fees, are like, well, I'm going to wait. I'm going to do it later. I'm going to see if I like the property, or I want to shop around somewhere else. Remember that we're working within the timeframes of the contract. So if you let the time pass without paying for these, you may jeopardize certain timeframes in the contract. Other of these loan related expenses include credit reports as well as points, right? When essentially you either buy down the rate or you pay the compensation of the mortgage broker directly, which happens on some loans. Okay. So all of these are loan related expenses. Now, the fifth section are expenses that need to be incurred, but because of lender underwriting requirements, the lender asks that you essentially prepay for them, or that you leave a deposit for these expenses in the future, right? When we analyze the HUDs and the CDs, what we're going to talk about is these are prepaids and escrows or impounds. That's how you will see it written in the HUD or in the CD, which are the settlement statements. What are some of these required prepaids, escrows, and impounds? Prepaid interest, right? So you guys know that interest, when you get a loan, interest are paid what is called in arrears. They're paid after you use the money, right? So when you get the statement on your mortgage, it will say March 1st, interest for the period of February 1st to this year, February 29th. You're paying interest back from money you already used, right? In arrears. But when you close on the transaction, it's the only moment where you're going to prepay the interest until the next period, because the bank needs to close without interest collected. The banks are also asking you to pay usually 1 year of homeowners insurance. The entire first year of homeowners insurance, they're asking you to pay for it at closing. Sometimes you'll pay for it directly, and so you're paying outside of closing, before closing. Sometimes you're paying it at closing, and the title company, we take that money that you deposited and we send it to the homeowner's insurance company. Now, because of underwriting risks, in addition to prepaying a year of expenses, the bank is going to want you to deposit some additional money. They call it escrows or impounds. They will usually ask you for an additional 3 months of payments to the homeowner's insurance. And they will usually ask you for anywhere from 3 to 8 months. I've seen even 11 months of future property taxes. Okay. Why do they want these prepaids. They want them to be deposited in an escrow account to ensure that they have enough money covered so that they always can pay in your name the insurance and the taxes. If you are a manager of risk, as are the underwriters of banks, the bank underwriters, their job, their existence is to protect the lender from risk. You agree? So if you need to protect somebody from risks, what are the risks that you most want protection from? The lender gave you a loan, and in the public record, they are what is called in the first position of that loan, right? Nobody can get ahead of them to say that they're going to take that property from the lender, except the government, if you don't pay your taxes. A government lien will have priority over the lender. So the lender wants to ensure that they have enough money to always guarantee the payment of the taxes to reduce their risk. Does that make sense? Now, in terms of the property insurance, they need to ensure that the property insurance is always in place, that it doesn't expire. Now, when you get to a certain level of equity in your house, banks sometimes will waive that insurance claim, but usually, and if you read the fine print of the documents, if you're getting a loan, you are committing to always having insurance on that property. And so the bank is collecting that money and they're putting it into an escrow account. And when you get all the closing documents, you will see what is called an escrow statement, where they will show you how much money is deposited in the account, and they will project the amount of money that they're going to collect every month towards the future as part of your monthly payment, and they're going to put it into that account, and then they're going to project when they're going to make the payments. So for property taxes, it's in November. For the insurance, it's in the 1-year renewal. All right? So these last two sections, the lender-related expenses, the loan-related expenses, and the lender-required prepaids, are two sections of expenses that solely exists on these loans. Okay? So now let's summarize. Title-related expenses, government recording fees and taxes, and other closing-related expenses are present in both cash transactions and loan transactions. Okay? Loan-related expenses and lender-required prepays are on loan-related expenses, only for loans. Makes sense, right? So how much does this cost? Well, as I told you, some expenses are related to the purchase price or the mortgage amount. Other expenses are fixed. So I can't give you an exact answer of what percentage of closing costs a buyer should expect on a cash deal or on a loan deal. I need to give you a range because of this variation. So in a cash transaction, the title-related expenses, government recording fees and taxes, and other closing-related expenses are about 0.75% to 1.5%. More or less, más o menos. The more expensive the property is, the lower the percentage of these expenses because the fixed costs get amortized, right? So if you have, let's say, $1,000 fixed charge, just to make it simple, you're going to pay the same $1,000 on a $250,000 property or on a $2.5 million property. So that $1,000 is obviously a much smaller percentage of the $2.5 million property. So the closing cost estimate on a cash transaction are usually 0.75 to 1.5. When does that percentage get even lower? That percentage gets even lower, usually starting around $3 million and up. After about $3 million, the percentage really starts coming down of closing costs. So if you have a buyer who's going to buy a $10 million property in cash, you can't tell them that the closing cost is going to be 1.5% because that's a lot of money. It's not going to be 1.5% in all probability. Okay? It's going to be much lower. Now, There are many transactions where the contract says it is a cash transaction, but the buyer is actually getting a loan. In those situations, what this means is that that transaction is not contingent upon the loan. If the buyer does not get the loan, they need to pay in cash. Do we agree? So if we project a cash closing and then they go and they purchase financing, we're going to have to adjust the numbers because now we need to pay the doc stamps on the mortgage, the intangible taxes on the mortgage, and you're going to have to do all the lender prepaids and escrows. Does that make sense? Yeah, great. So closing cost in cash, about 0.75 to 1.5%. So now let's move it over to the loan. How much are the costs related to a loan closing? Well, the first three costs, title-related expenses, government recording fees, and other closing costs are about 1.75 to 1.5%. Now here, remember, we also have to pay the doc stamps on the deed and the intangible taxes on the deed. So obviously, that section is going to be higher on the loan deal. And then you have to add about 0.75 to 1.5% of the loan-related expenses and 1% to 1.5% on the lender-required prepaids and escrow. So more or less, on a mortgage transaction, you're looking at about 3 to 5% of the purchase price is going to be the closing costs. 3 to 5%. So in cash, you have 0.75 to 1.5%. In mortgage, you have about 3 to 5%. Once you start getting above $3 million purchase price, those expenses percentage-wise start coming down, okay? Now, let's talk a little bit about settlement statements, okay? Let's talk a little bit about settlement statements. Settlement statements is the generic term given to a document that outlines all the financial details and costs associated with the purchase and sale of the property. So the word settlement statement is just a type of financial document that shows the costs and the details associated with the purchase and sale of a property, okay? What are the general components of a settlement statement? Well, you have the sale price, how much was the property, what are the title insurance costs, what is the loan information, what are the property taxes, the prorated property taxes. We're going to talk about prorations in a bit. What are these closing costs that we just reviewed? What are the prepaid expenses? Are there adjustments that need to be made because the seller prepaid some things? For example, maybe the seller prepaid the month of the condominium and they're closing in the middle of the month. Well, they paid the whole month up front, right? So the seller prepaid that. They need to get reimbursed. Maybe the seller has not paid something. If you close before November, you know the seller is going to get a tax bill in November, but they haven't paid their portion of the property taxes. So the seller needs to have an adjustment there. And then, of course, agent commissions, right? So the settlement statement details these expenses and costs. Now, I want to talk about three kinds of settlement statements that you will hear. You're going to hear a lot of stuff in the street, right? And obviously all of us have a primo, we have a cousin, right, who knows everything about everything, and they're going to use these words, right? So we're going to have to know what these mean. So the first kind of settlement statement I want to talk to you about is called the closing disclosure, the CD. You guys hear CD, CD, CD. A CD is a kind of settlement statement that is federally mandated to be used in residential real estate transactions for properties that are financed with a commercial lending institution. If you have a private lender, they may not use a CD, but commercially backed, mortgage brokers, Bank of America, Wells Fargo, UWM, Rocket Mortgage, they use the CD. This document was created by a mandate from the federal government, okay? And it was created to provide the financial details of the mortgage that you selected. And it's going to include the terms of the loan, right? It's going to tell you what the interest rate is, if you can prepay the loan or not, what the monthly payment is, how that monthly payment is broken down, right? You usually have principal, interest, insurance, escrowed insurance, and escrowed property taxes, right? So that's what's usually going to make up your monthly payment. The CD on its very first page gives you all these details. The CD also tells you on the very first page a summary of all the closing costs, and it tells you how much money the buyer needs to bring to the closing table. How much is the final, what they call cash to close, right? What is a cash to close? So you're going to hear about CD a lot. So if your residential real estate buyers are using a commercial lender, they will have a CD. And there's several rules around the CD. First of all, a CD, with very few exceptions, needs to be provided to the client at least 3 days before closing. For reasons that are beyond my level of study, that CD can actually be sent to a client without it being the final CD. There's a lot of different adjustments that can be made to that CD. There are other adjustments that if they are made, you have to restate the CD and wait another 3 days. Okay. A CD has a cousin, has a younger brother at the beginning of the transaction that is called the loan estimate. The loan estimate is a format that is very similar to a CD. And if you don't look closely, you might be fooled. And the way you know it's a loan estimate is because the title says loan estimate, right? That's how you know the difference between a loan estimate and a CD. Now, the loan estimate is important because, thank you, the loan estimate is important because that is where the projections of the costs are, right? So a client may have seen this loan estimate, right? And what you would love, especially if you're a realtor or if you're a lender, is that in that loan estimate, your title company send you their projected expenses so that the client sees a loan estimate that is as close to what the final numbers is going to be as possible, because the client is planning how much cash they need. That makes sense. So on the CD, especially the one that is given to the client 3 days before, there is a projected cash to close. And if it's not final, it could vary. And this causes confusion. It causes frustration. The mortgage broker is frustrated because they want to give their client an answer. The title company is frustrated because they sent their numbers at the beginning of the transaction. The buyer is frustrated because they don't have a final number. Okay? This is the result, in my personal opinion, of a lot of regulation, and all it requires is coordination. This is why realtors and lenders and title companies, we must work together as a team, because all of us are looking at different pieces of the transaction. And to get the client one single view, you want to have a lot of coordination. Makes sense. I'm going to move on to the second settlement statement, which you will see in almost every single transaction you ever close, right? Whether it's a loan or whether it's cash, you will probably see the ALTA settlement statement. The ALTA settlement statement. How do you know it's an ALTA settlement statement? It says it in the title, ALTA settlement statement, right? And the reason I make this joke is because many times when we're talking about expenses, what I've noticed is that everybody gets really nervous. Everybody gets really nervous. This is absolutely normal. So, you just have to kind of take a step back and start reading the document. Now, the ALTA settlement statement will have a breakdown of the expenses in a little bit of a different format than what you saw in the CD. The CD in a loan usually is accompanied by an ALTA settlement statement. So when you're doing a loan closing, you actually have both documents side by side. They obviously have to say the same final number, right? The expenses have to be the same. It's just the formats are the same. So in the CD on the first page, you have very clearly laid out the loan terms. In the ALTA settlement statement, you really don't have such an easy to read format for the loan terms. What you have is all the expenses in the middle, and on one column, you have everything related to the buyer, and on the other side, another column, everything related to the seller. And the way that that ALTA settlement statement works is through a system of debits and credits, right? So for the seller, right, you have their expenses and what they're going to get credited, and that difference is going to be what's going to be paid to the seller, right? So if the seller has a mortgage, the mortgage is going to be a debit from the seller, correct? On the buyer side, the debits from the buyer are what the buyer actually has to pay for, right? Until they get to their cash to close, right? Now, think about this for the cash to close, because the final result of everything on that ALTA comes from this formula, right? And I appreciate all of you for being such a good sport, because you don't have your slides in front of you, but I'm going to try to make it as visual as possible. So if we start with the purchase price, and then we subtract the deposit because the buyer already gave it, and then we subtract the loan amount because the bank is going to give it, correct? We add the closing costs. We add the expenses. That difference is what the buyer needs to bring at closing. Purchase price minus deposit minus the loan amount plus the closing cost is your cash to close. Of course, if there are credits, right? Maybe the seller gives a buyer a credit. If the buyer gets a credit, they have to bring that much less money to the closing table. Do you agree? And so this system of debits and credits, when you first see it, I think most people get a little bit shocked because they don't really know what they're looking at. But actually, when you think about it, it makes sense. Why do people need a settlement statement? They want transparency. They want to be able to ensure that everything that was discussed in terms of expenses is present and is explained. Because your buyers and sellers and realtors and mortgage brokers have the right to get the closing costs explained. And your closing agent should explain them to you. Now, there are expenses that the closing agent is bringing, let's say, from the lender or from the association. The closing agent will tell you this is coming from the lender. The lender is charging X processing fee. So if the client at the closing table asks the notary, why are they charging me a processing fee? The notary very likely is not going to have an answer as to why. But the notary can tell you that that is a lender-related expense. Does that make sense? I hope it does. Now, a very common question at closing has to do with the proration of property taxes, right? You see, property taxes are charged on an annual basis, right? And I'm not going to get into the differences of property taxes because there's ad valorem property taxes, there's non-ad valorem property taxes, and that's a whole different beautiful world of property taxes. That beauty we will not talk about right now. But the property taxes that need to get paid from, let's say, January 1st to December 31st, right? But they get charged in November. So what happens if the seller lived in the property from January 1st to March 31st? And then the new buyer starts living on March 31st to December 31st. Well, the seller hasn't paid their annual property taxes. But the seller was the owner of that property for 3 months. So we have to get last year's property taxes, and we find the daily rate of those property taxes. And then we multiply it times the amount of days that the seller was an owner. And that seller needs to provide that credit to the buyer. Because in November, the buyer is going to pay for the whole year. And the buyer doesn't want to pay for the 3 months that the seller was owner. Do you agree? Hopefully, yes. Okay. The ALTA settlement statement breaks all this down very beautifully, right? And I know it's weird to say that this is a beautiful statement because it's so scary and confusing. But once you get to know it, you will love it. And if you don't, please ask. um, because this is part of the work of the closing agent. The closing agent, the realtor, and the lender, I am sure, all want absolute transparency for their buyers and sellers. All of our businesses rely heavily on referrals. You want your clients to refer you other people's business because they had a great experience with the lender, with the title company, with the real estate agent. So giving the confidence that the client needs at closing, that they know what they just paid for, it's very simple to achieve, and it shows that they were in good hands. And so they can refer you more business. Does that make sense? Okay. So I'm going to add some additional resources in the video and in the presentation that I'm going to send you. A very, very good resource that I would like to share with all of you is the website of the Consumer Financial Protection Bureau, CFPB. The CFPB, which some people love and some people hate, but that's normal in government, is the agency, the federal agency that really is supervising how consumers get treated. And they were the ones that were tasked by federal legislation to create a lot of these rules around disclosures of mortgages in particular. They have a wonderful interactive tool that explains line by line of how the closing disclosure works. It's interactive. They have it in more than 10 languages, and it's free. Okay. So if you guys want to continue to educate yourself on this, you will see that I have included the link and the slides to the Consumer Financial Protection Bureau. Okay. Now, let's talk a little bit about how Folio can help you and your clients, and then we'll go into the Q&A. So, do you know how many title agents there are in the state of Florida? Probably not. There's over 10,700 registered title agents in the state of Florida. That does not include attorneys who can do real estate closings. Does the world need another title company? Why does Folio exist and why are we different? This was a very important question to answer when Folio's founders got together to explore if this was a service that we could provide to our community. I truly believe that the first thing that makes us different is our values. We are guided by an appetite to serve others in these transactions, not just serve our clients, serve our real estate agents, serve our lenders, serve inspectors, serve as a resource to those involved in a real estate transaction. That might sound like everybody says they have good service, but this isn't about good or bad service. This is about the act of serving and wanting to be a part of a solution of a real estate transaction. Why? Because another value that you need to have in this business is problem solving. There will be problems on almost every single transaction that neither the lender, nor the real estate agent, nor the title company can really control, nor the client for that matter. So we're going to have to come together and solve the problem. Some people like problem solving, other people don't. They get really nervous, right? And the clients who usually are buying their first home, or they don't usually have this experience. What we want to do is we want to give them the confidence that you can be calm, there will be transparency, and we will get these problems solved. The second thing that makes us different is our team. One of our partners, Nelson Taracido, has been doing real estate closings for 25 years. Some of our paralegals have almost 30 years of experience. We have a combined over 100 years of real estate closing experience, and not just as closing agents. We have a lot of a multidisciplinary team that really can look at these transactions from all different points of view. We focus on partnership. We know that we are one part of the real estate closing solution, and we focus on the experience that we create for our agents, our clients, and the lending partners. Of those 10,700 title agents that exist, we believe that we have a better mousetrap. This is a business that has been done more or less the same way for about 125 years, maybe more. And we believe that we have come up with an approach, with a method that is better, because we're able to take the individual context of every transaction, knowing that it's different, and we can provide a workflow, a roadmap for that transaction to get closed as efficiently and quickly as possible, depending on the specific context of that transaction. We have awareness of how a transaction really works. You can have all the checklists in the world, but we're dealing with people, and people have emotions. Some of those emotions are happy, some of those emotions are anguish, fear, anxiety. Realtors are fearful. Is the transaction going to close? Clients are fearful. Am I making the right decision? Sellers are fearful. Where am I going to go? Everybody has a level of humanity. And so what we need to ensure is, what can we do to make these factors work together to get to where we want to go? You have to do it understanding that there can be a difference between expectations and reality. The bigger the gap between expectations and reality there is, the more noise there's going to be in the transaction. So why don't we work together to reduce the gap? And at the beginning, we have these onboarding calls where everybody, client, real estate agent, lender, title company, can participate together, and we all talk about the transaction so that we know what they can expect. People don't know what they don't know. So there's a component of hand-holding, education, learning that happens throughout the transaction. And the last one, we can obviously only focus on what we can control. So we have to understand, what can we control? What can we anticipate? Anticipation in real estate is extremely important. Our track record speaks for itself. We have been privileged to be named one of the top 25 title agents in the state of Florida by our title insurance underwriter for 2 consecutive years. And for the last 7 years, we have been in the top 100. That is a testament to what our team has created in building this service-based title company. How can we help you and your clients? A lot of the magic begins before contracts get executed. If you use the Florida as-is residential form or some of the other forms provided by local associations, many of those legal terms and conditions have already been set. And what you're really negotiating and what is really causing anxiety are the business terms. Should I do 10 days of inspection or 15? Do I need an addendum for a 1031 exchange or not? What can you recommend if the seller wants to stay after the closing? These are part of the negotiation. And if we can help you, we have teams of people to help you before you can execute that contract. And we create this context-aware contract so that when we go into the transaction, buyer's agent, listing agent, buyer, seller, title, lender, we are more or less aligned to have as smooth a transaction as possible. So the magic begins when we review these contract business terms and when we go through the closing cost estimates, so your clients have full transparency. During the transaction, we do as much as we can for proactive and secure communications. We have onboarding calls, and we have encrypted WhatsApp messaging groups for you with our team, as well as your clients with our team. So there's direct access, right? That I have found gives everybody a sense of empowerment and the fact that you're really not alone in the transaction. We assign a transaction team and a single point of contact for the realtor and the client, and a single point of contact for the lender and the seller's attorney. That way, everybody should know who they need to speak to. And sometimes there's a lot of people involved and it gets confusing. And we work every day based on your feedback to make that better. But this method has allowed us to reinforce this open and transparent communication and eliminate bottlenecks. We can close anywhere in the world. Folio Title was one of the first companies to do international closings online in Latin America, Europe, and Asia. And it is one of the things that most of our clients love to explore. Not every transaction can be closed remotely, internationally, online, but we could talk about it as you're thinking through the contract. Okay. And then post closing support. Every transaction after it closes, there's some things that need to happen after the recording of the deed, the emission of the title insurance policy, maybe a water holdback, maybe an issue with the association. So I'll stop here. I deeply apologize for the sound and presentation issues. Hopefully, I tried to do my best to make it as simple as possible and enjoyable. So what I'd love to do now is answer some of the questions that we have here in our chat group. Okay. We will share the presentation and we'll share the recording. And what I am committing to doing is I'll re-record it for you guys with the presentation so that it actually makes sense. Let's see here. So very popular question from Andres. Thank you, Andres. When do we select in the title related expenses option 1, 2, or 3? And when is it important to pay or not pay the title insurance? So I told you guys that in different Florida counties, there are customs about who chooses the title agent and who pays for title insurance. I believe, this is a personal opinion, that it makes sense that the buyer wants to control the due diligence process. Remember, as a title company, we're running the due diligence on the legal history of the property. The buyer is the one who's going to live there, and the buyer is the one who's going to get the policy. The buyer really wants to work with a trusted agent. But there are counties where sellers have ingrained that they should do this, and so you may not be able to go against that. Now, what about if you're in a county like Miami-Dade or Broward, where it's traditional that the buyer chooses, but you have a listing? What kind of listing do you have? Is it an international client that can't travel, that is subject to FERPTA? Are there 1031 exchange issues? Are there issues on the property because maybe they went through a probate? There will be occasions where I would argue that it makes sense that the seller choose the closing agent and pay for title. This is part of the negotiation, right? This is part of how it happens. Now, you need to be careful if you're a real estate agent because there are rules, there are laws around some of these issues, right? So you have to be aware of these and you need to know what it is you can negotiate and when. If you have any questions about these, please let us know, okay? If you're preparing a contract for your buyer and you're in Miami-Dade or Broward, 99.9% of the time, you're going to choose option 3, the Miami-Dade Broward regional provision. If you're an Orlando agent preparing an offer for your buyer, many times you will send the listing agent the seller pay title option, and the listing agent will understand. Now, you could send them the buyer pay title option and maybe ask for a credit. That's an option. It's a negotiation, right? But what it has to be is it has to be transparent, right? And it has to be understood by both sides. Thank you, Andres, for that question. The estimated percentage of closing costs should vary now that the buyer will be paying for the buyer agent commission. That's an excellent point. That's an excellent point. So buyer agent commissions have been around since the beginning of the real estate industry. I want to make sure every real estate agent in our webinar today understands that, right? Many countries have established for centuries that buyers pay buyers real estate commission, buyer agent commission, and sellers pay seller agent commission. Okay, so that option was always on the table. Obviously, if you reach a buyer commission agreement with a buyer as a real estate agent, the buyer's closing costs are going to go up, obviously, right? Now, the question becomes what happens to the purchase price? Because buyers always paid the commission, but it was in the purchase price. They didn't take the commission from their side of the ALTA settlement statement. That was on the seller side. But when the seller was evaluating selling the property, they put a price understanding what their cost structure was going to be, because at the end of the day, the only thing that really the seller cared about is how much money they're going to keep in their pocket. So if they went to a listing presentation and they said, I would like X amount, what are the expenses? If the expenses are 7.5%, which is pretty customary for a seller, the seller said, well, I want this amount plus 7.5%. That's going to be the price. So while it is true that buyer agent commissions are now going to move to the ALTA side of the buyer, it's going to increase the buyer's closing cost. And those costs for now cannot be financed. It also should mean that you should have some leverage on the pricing. Okay. Thank you for that question. A great question from Sonia. Is there a law that caps the amount of expenses? Is there like an amount of expenses beyond which you cannot charge in total? I do not know of a law that would do that. If there is, I don't know of it, of a maximum allowed percentage. I don't know that there is a law that does that. What happens if the entire amount of the realtor's commission is not reflected? That could be a tricky question. I would say that if you're getting a commercial loan, you really want full transparency on the CD and settlement statement. If you guys want to learn more about non-transparency on a loan deal, you can Google mortgage fraud, and in a very short amount of time, you will probably realize why being transparent on a loan deal is the only way to go. Okay, loan deals are regulated by federal law, and they're very, very strict about the disclosure of expenses. So, that whole, well, the buyer and seller are negotiating out of closing and the seller is going to give me an additional check under the table and all that, that's just not a good practice. It's just not a good practice. And it very well might be illegal depending on the kind of transaction you get involved with. Another great question here. Why is a proration of property taxes based on last year's value instead of property taxes based on the selling price? That's a nice question. That's a very good question. So the contract has a paragraph that explains how the prorations are going to work. Okay. There's actually 3 general moments of the year in which these prorations could vary. The first part of the year goes up to about January to August, more or less, which is when there's no information about what the upcoming taxes are going to be. So the as-is contract says you're going to use last year's taxes and you're going to remove 4%, the 4% discount from those taxes, and we're going to use that value to prorate. At about August, the county is going to send what is called the trim notice, where they have some projections of what the property taxes could be the coming year. And so you would use some of those values to project the taxes. And then, of course, after the taxes come out, if you close between November 15th and December 31st, you have the tax bill in your hand. So you would use those. Okay. Now, very important that you guys know that in the as-is residential contract, there is a clause that allows buyers and sellers after closing to reprorate. This is one of the clauses that actually survives the closing. So if the seller gives the buyer credit in a July closing and the November taxes are much higher, the buyer can reprorate by going to the seller and showing the proration and saying, well, here's the ALTA settlement statement that we signed. Here is the proration and the tax amount, and here's what the real taxes were. And there's a big difference. I would like you to reimburse me the difference, right? The buyers have the right to do that. And the sellers sign their obligation to do so, okay? Another great question. We have great questions here. If the property that is being purchased is new construction, the estimate of the expenses goes up to about 6%. And in some cases, the developer can add expenses. That is absolutely true. When you purchase in pre-construction, there are other expenses that a developer will include in the contract, like a developer fee, right? Some of those fees are hefty. Now, the flip side of that is that many times the developer will provide you incentives towards your closing costs. Okay? The developer will provide you incentives towards your closing costs. So it's very important that your clients read that fine print. I get calls every single day, multiple times a day, from real estate agents, particularly saying, I have a client who's going to buy in pre-construction. They want to understand the contract. When I ask the question, many times I realize the client has actually never seen the contract. So what I invite the real estate agent to do is to have the client write down what their doubts and questions are. Because the one who's going to close the transaction on pre-construction is usually the developer. And so in all that little fine print that you're signing in that contract, you can email the developer and ask them the question. And ask them, can you tell me on this contract where it says where my closing costs are going to be? Can you tell me on this contract until what date I have to cancel this contract without risk of losing my deposit? Can you tell me on this contract where it says that if I want to assign the contract to an LLC, I can do so without penalty? I got a call yesterday around 8 o'clock at night from a real estate agent who said her client is closing a pre-construction on Thursday, and it is a couple that is not legally married. So only one person, only one couple was on title originally and on the loan, and now the other couple who is putting part of the down payment wants to be on the title. And the developer is saying that 3 days from closing, they can't do that. They needed to wait 30 days. And so they would lose all their incentives. So now we have a potential title issue, which I cannot solve for them. No, I cannot solve. So they were talking about what can they do after closing, etc. So they're, getting this right and getting your clients to ask you these questions, especially on these developer deals. When you're negotiating the contract, it's important. Okay. Thank you, Sonia. That was a great question. Is the presentation available in Spanish? Thank you for the question. So as you might have noticed, this was the first run of this presentation, and therefore we had a couple of technical difficulties, which we will fix for the second run, which we will do in Spanish. So for all our audience that wants to listen to it in Spanish, you will get a Spanish invitation soon. So hopefully that's good. How many times have you seen a buyer getting a tax proration returned or refunded? It is indeed difficult. It is indeed difficult. And many times the buyer would like the title company to arrange for this. That is something outside of closing that the title company really doesn't have control over, right? So it's important. I mean, the title company may facilitate. We may write an email if the seller had an attorney. If the seller didn't have an attorney, maybe they moved to another country and you can't find them. So this is part of the reason why during closing, if the buyer can have a relationship with the seller, their contact information for after closing, these are good tips to know. So with that, we're going to close today. Thank you so much for all of you who stayed on today. I hope you enjoyed the live stream. We will be sending you a recorded version with the slides. And please ensure that you can reach out to us for whatever you need. I am putting in the chat our email, hello@foliotitle.com, and where you can call us and you can ask for any one of our onboarding members. So thank you everybody for joining. I hope you enjoyed this presentation. And despite without having slides, I hope you guys enjoyed it. Thanks everybody. Have a wonderful day.